Welcome to the daily insights that matter. In the midst of a global slowdown, India's economic landscape experienced some worrisome growth in the first quarter of the year as net FDI declined sharply. Foreign direct investments in the country declined to $4.99 billion in the first quarter of the year from $13.92 billion as compared to the year-ago period. Manufacturing, financial services, business services, computer services, electricity and other energy sectors accounted for more than two-thirds of the fresh equity flows during this period. When looked at the breakdown of how India fared in the first half of the year, the sector that received the highest FDI was renewable energy, followed by electrical components and metals. The other sectors in the top 10 were communications, semiconductors, oil and gas, etc. When looked at the countries, Singapore, Netherlands, Japan, the US and Mauritius were the major sources for accounting for the FDI. The decrease in FDI inflows to the country was on the back of a looming global slowdown with high inflation and interest rates. According to the RBI report, the moderation in gross inward FDI coupled with a rise in repatriation of investments resulted in the decline. Though India is positioned in a sweet spot, global headwinds could pose a hindrance to India's FDI flows in the near term. With the ongoing strong PLI scheme and capex push in the country, it should offset the hurdles posed by the global economies. So on Thursday, we witnessed a 20 paise drop, landing the rupee at a new record closing low of 83.15 against the US dollar. A couple of factors seem to have played into this situation, with that of the rise in US bond yields and a fall in the Chinese yuan. The dollar has been on a gaining streak this week. The surge was triggered after the US Federal Reserve hinted that additional rate hikes might be necessary to manage inflation. What happened next was that yields on US bonds shot up, causing the dollar to strengthen. This is because higher yields make the US securities more appealing to global investors. Now, when it comes to the Chinese yuan, the plot thickens. The depreciation of the Chinese yuan often is on the back of concerns about economic well-being of China. This can trigger a shift in investor sentiment, prompting them to opt for safer assets like the US dollar. As a result, currencies across emerging markets, including our Indian rupee, tend to weaken. While the current decline in the rupee is closely tied to the robust performance of the dollar index, it's important to understand India's ongoing efforts to promote the use of the rupee in international trade. This move towards de-dollarization and currency diversification is noteworthy. For instance, just this week, the Indian government made a significant announcement. The country's leading petroleum refiner, Indian Oil Corporation, opted to use the local rupee for purchasing 1 million barrels of oil from Abu Dhabi National Oil Company, bypassing the US dollar. However, breaking free from the stronghold of the US dollar is no simple feat. The US dollar has enjoyed a long-standing reputation as a safe haven and is widely accepted across the globe. Transitioning away from its dominance requires careful strategy and effort. Looking ahead, the long-term prospects of the rupee to achieve greater recognition on the global stage are based on a variety of factors. These include the trajectory of export growth, the feasibility of achieving capital account convertibility, and the sustained development of our economy. While challenges undoubtedly persist, these elements could pave the way for the Indian rupee to carve out a more significant place on the international currency map. With that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com